Recording
Welcome
in
to
progress.
welcome to today's session. Thank you for joining us. My name is Shoaib Zaman. I manage the product communication at Axis Mutual Fund. Building up on our previous webinar on asset allocation, today we'll be delving into the product and category of Balanced Advantage Fund. Our speaker is Raghav Iyengar, Chief Business Officer at Axis Mutual Fund. He has over 25 years of experience in the mutual fund industry, and given all his experience, we were looking forward to hearing great stuff and having a new learning curve. Over to you, sir.
Thank you, Shoaib. Good morning, everyone. On behalf of Axis, first of all, thank you very, very much for taking this time out on a Saturday morning. Especially, I know it's a weekend morning, and I'm sure a lot of last-minute shopping for the festive season is yet underway. We'll try and keep this short and sweet because the category. This is a very, very exciting category in the last, especially if you look at the mutual fund statistics that gets published every month. The balanced advantage category is a unique category. It has actually seen a huge amount of growth. Why is that happening? I think every time there is uncertainty in the market, there is some issue. Can we just have the PPT, please? If you don't mind? Uh, just a minute, audience, please. Thank you. Thanks, sir. Yeah, thanks, sir. So I think every time there has been some volatility in the market, wherever there has been some issues along the way, the immediate direction of the market has created some stress. Investors tend to come in here. It's in some sense, if you remember the old ad that we used to have, the old Hero Honda ad, where it used to be like a fill it, shut it, forget it fund. And I've been a very, very old passionate investor and a passionate advocate of balanced advantage fund as a category. And of course, I'll try to just take about 10 minutes to try and tell you what is unique about Axis Balanced Advantage Fund. It's a big category. The statistics are it's almost about 10% of all equity assets. As I said, it's the fastest growing category. Over the last 2-3 weeks, we've seen markets go through some very, very interesting times. We have some very, very marquee NFOs coming up over the next couple of weeks. And I think a lot to talk about, actually. So let's just dive into our presentation. The plan for today is to just try and take you through these quick. We have about 15, 16 slides. We'll just try and do that in about next 25, 30 minutes. And then last time when we had done the asset allocation seminar, we had a lot of feedback from many of you saying that, hey, we'd like to have some more time for question and answers. And this time, that's the plan, to try and give more time for you to ask questions, and hopefully I'll be able to add some value to that. Yes, so on that note, again, my thanks to you to come in on this Diwali week. A very, very happy Diwali in advance. I'll possibly be saying that more often. But yeah, next slide. So I think the key thing on this slide, and there's a lot of data on this slide, so I'll just take a couple of minutes on this. As you know, we've gone through a very, very interesting phase, a very tough phase, if I may to put it, a very, very unprecedented phase. These are the typical words that we have heard. We haven't had a health crisis of this magnitude globally in the last 100 years, right? And the chart on the right and the left essentially tells you what has happened to the markets, what has happened, more important, to Nifty volatility. So you had a phase like last year where everybody didn't know what was happening. I think you had unprecedented measures taken by governments across the world, where countries were effectively stopped. I mean, we were like told from tomorrow morning, you can't go out, you can't go for your morning walk, you can't go down to buy your eggs, you can't go to office, kids can't go to school. And we'll figure out where this pandemic is heading and then slowly get you back. And that actually, obviously, markets are in some sense barometers of the economy. When the economy stops, obviously the market did what it was supposed to do. It crashed. And it fell like 30-35%, right? And if you see over the last 1 year, that's the interesting thing. There's not a single, I mean, if you were to look at this chart in the middle, I hope all of you can see it. I'll send these slides to anyone who wants it. But there's not a single, the lowest return, the lowest, and I mean is the auto index, which is 34%. Now, just translate that back to maybe 12 months back. Life, if when you looked at 1 year returns at that point of time, life would have been very, very, very different. So the first phase of life, of course, is that, and unfortunately, a lot of the news flow tends to focus on the immediate. But if you look at what has really happened, we've had Again, a huge combination of liquidity, which is basically the central banks providing additional money. As you know, money is the lifeblood of any economy. Obviously, when the economy stopped, to get it revived again, to give it a medical parlance, they had to get the blood flowing back. And in some sense, the money flow, they gave a lot of it. They lowered interest rates, which is the cost of borrowing money, because obviously when you have paying very high cost of borrowing and the company is not able to meet it, that can lead to what is called a financial contagion. If you remember, it happened a bit in 2008 when the global housing crash happened in the US, and then obviously you know what happened after. So most central bank regulators or most governments, most banks were very, very worried about that phenomenon. So they actually brought interest rates down to make things a little more affordable. It also added a level of consumption. So ultimately, you and I are the reasons why economy works, right? Because we consume, we buy, and that in turn tends to keep factories produced, labor gets paid, and now of course life is changing a bit because the traditional industries are in some sense slowing down. You have the new economy which is growing, but all that ultimately needs a certain level of output for it to keep functioning, and that's where the economy really took off in the last 12 months. So if you can see the sectors which have done really well, the green one has obviously been the real estate index. Now, just rewind 2 years back, most real estate companies were in bad shape. So you will ask me what happened to real estate in this last 12, 15 months. I think obviously interest rates went down. There was a lot of SOPs or subsidies that were announced, various state governments. Like I know in Bombay, where I stay, last year at this time, the real estate market had just started to pick up because the state government announced a big crash or a big reduction in stamp duty, and that continued all the way to March. And of course, you had a lot of buying interest coming back. And of course, then we can talk about the other things: work from home, people shifting from smaller houses to larger houses. Second, third times are now 2-tier, 3-tier towns are now where a lot of the action is happening. So all in all, a lot of data on this slide. But just to tell you, it's been a broad-based rally. What it means is that in the past, if you go back to 2018, when the last time equity markets did so well, you had a few stocks which essentially went up and a large part of the market stayed where it was. So it was a standard problem I used to get everywhere when I used to meet you, that, hey, my market is at a different level. Market is at 30,000. If I remember those days, 30,000 was the big peak. And today, everyone's happily forgotten that. But the questions I used to ask was, hey, 30,000 index and, what do we do now? And why my portfolio is not. So unlike last time, I think this time it's been a bit more broad-based. You've had obviously the mid caps and small caps also doing well. Right? Next slide. Just tap it against it, please. I think there's another chart that will come. No, I think. Yeah, I think, sorry, just go back again. I'm so sorry, audience. I think our computer's also a bit on a Diwali break, but just to quickly put this across to you, I think you had very, very strong capital flows. What that means is a lot of overseas capital is coming to India. Now, why has that happened? I think obviously the object of any money manager or anybody is to sort of make money. India is seen to be one of the few places where there is huge growth potential left over. We are 1.3 billion people. We are a fast demographically. We are in a beautiful place because we have a very young population which wants to consume. So everybody wants to come here. India has also had a lot of stress in the past because of the way that we operate. Some of our laws are very antiquated. We are seen sometimes to be a bit investor unfriendly because we do have this rich poor differentiation, and we're very, very worried about this whole Soot Put Sarkar thing that keeps happening all the time. But that's all changed a bit in the last year a lot, because I think there's been so much of money, not only in India, across the world, looking for return. And that's actually happened over here to us too, in the sense that you had almost huge amounts of money coming in. In fact, in the next 10 days, very, very contra-cycle, but most of my friends like Access Capital is one of the largest arrangers of equity and debt fundraising in the country, our associate company. And they're having a very busy week because, next week, starting 8th, you will have India's largest public issue being launched, which is the Paytm issue, right? And next week, you have Policy Bazaar, which is another fintech-based company. And of course, as you know, right now, we're going through a very interesting company called Nika. So in the last 3 days itself, you've had announcements of 3 very new age, very differential economy companies coming in and raising a fair amount of money at a reasonably good valuation. They're not selling it at a throwaway price. In fact, the valuation, many people I don't know much about it, but many fund managers say that it's difficult to gauge these funds. And many of these companies didn't exist 10 years back. So that's the beauty of India. And of course, what these companies have demonstrated is that, if you get your business model right, you get your pricing right, you get your value proposition right, for them to grow 5x, 10x, 15x is very, 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 very possible. And that's what I think the market is looking at today. So we have almost about 25 odd more public issues coming up. I think this year, in fact, that's possibly one of the reasons why you've seen a bit of a slowdown in equity markets in the last 48 hours, because ultimately, if I have to put X amount of money in Indian equities and I'm already invested, I will sell some of my existing holdings to try and make up some cash to invest into to the new IPOs, especially if I like the companies that are coming on. Some of them are fundamentally very, very interesting companies to put in. So that's also one take, which people tell me that why the markets have been so slippery, especially in the last 3 days. Right? Next slide. So I think clearly, I think the outlook, if you were to look at it, we have been possibly the best performing emerging market this year. That means that markets are divided into two: developed and emerging. We are part of the emerging market basket, right? Interesting thing is that now rates are slowly starting to climb up. RBI has now started indicating that the amount of extra money that they put into the system is slowly going to start withdrawing that, and that will have its own consequences. Rates will slightly move up again. We've seen a huge amount of money coming. In the month of October itself, we've seen almost a couple of $1 billion of money coming in, and this is without the IPOs having been coming in. You all know the statistics about the number of new demat accounts being opened. So in some sense, there has been fair amount of participation and interest in Indian equity markets. We expect that to continue. And today, the challenge that everyone faces, including me, is that, hey, am I putting money? Is 58,000 the right level? And trust me, I've been in this business now for some time. I've seen indexes at 1,000 points. So in that sense, it's been a great learning for me. Markets have taught me a lot. And one thing I've realized in this space is that one needs to be always constantly invested in the market, and obviously try and make sure that you're getting in and keep your asset allocation absolutely fine, which is where I'm a big, big proponent of asset allocation. What does asset allocation mean? Just as a flashback for all of us, it's just that you keep your money in various different assets like equity, debt. Nowadays, gold is also possible. You have a lot of paper gold available. Real estate has always been one of the big investments in the Indian context. That's largely because everyone wants to have a house. A house signifies stability. But there are large real estate investment opportunities available, especially on the commercial, on the office side. Nowadays, REITs have come. So you keep a little bit of money across all these assets so that you are well diversified. Right? That's the whole idea of a mutual fund, if you remember, was that instead of you and me going and buying a couple of stocks, which is what maybe our 5,000 or 10,000 rupees can get you, you are able to get a whole basket of investments, which will give you, on a risk-adjusted basis, a decent return. Right? One theory we have in Axis is that if you take care of the risk, if we manage the risk properly for you, the returns will take care of itself. That's been a bit of a cornerstone of our investment philosophy over the last decade or not that we've been investing money, right? So I think in some sense, yes, are there a lot of issues? I think our view is that India is in an interesting place. If there are issues, and we have seen that this last couple of days of correction have largely been because of very, very high FII selling. That happens. One doesn't know why FIIs buy or sell. They have their own reasons to enter or exit a particular country or a stock, correct? So if that happens, obviously that's where you will see some volatility. And the solution for that in some sense is asset allocation. And the solution for asset allocation is in some sense balanced advantage. So let's just jump in now to balanced advantage data. Next, please. So this is typically what an investor expects. And unfortunately the market is on the other side. And if you have days like last 3 days, sometimes that road tends to come back also. It's a U-turn, right? You don't always go straight. The road is curvy, the road is different. And investors obviously want a slightly smoother journey because nobody likes volatility, right? Nobody likes to say you invest at 10,000 rupees today and then see it at 9,900 tomorrow, 9,800 day after tomorrow, and then suddenly jump to 10,000 tomorrow. Everybody wants, hey, just give me 20 rupees every day and I'm very, very happy. Unfortunately, equity markets don't behave like that. Why don't they behave like that? Just take it in the next slide, please. Some of the reasons, as I said, FI inflows, outflows, they are very large holders, or rather, in some sense, investors of Indian stocks as a block. Apart from the promoters, are FIs. In fact, they own more equity than maybe the retail investors. That is changing a lot thanks to behavior that people like you are watching this call or this ad, that people are now realizing in India that, hey, equity is not for the class. Equity is not for the institution. Equity is actually for the mass. In some sense, today's fintech world, ability to transact, the new payment mechanisms, the whole government initiatives around digital have really helped bring about the execution part of that. So there was a lot of issue around earlier investments. It used to be a little complicated, especially for smaller investors. I think today the industry, the regulator, the government, more importantly the regulators, really making it very, very, very simple for let us say normal retail investors to participate. But the fact is that as retail investor, will have to contend with all of this, right? Central bank action. Say why? What is central bank action? Tomorrow, the U.S. government or the U.S. Federal Reserve decides to cut back some of, they've also been putting a lot of money into their system. They've been literally printing money. They decide to stop printing or curtail printing of that money. You could see some money moving out because a lot of this money is actually in some sense trading oriented. Earnings of companies, in my opinion, actually the biggest fundamental reasons why stock markets do well or companies do well or badly is how they perform. But again, like I showed you in the previous slide, these companies are not, you will never have earnings going in a straight line, right? You will have some potholes, you will have some curves. And so when people get quarterly earnings, or especially in companies, especially listed companies, have to report their earnings every quarter. So it's almost like a quarterly report card. So every time you can't get to be an A plus, there are circumstances. Sometimes where the company doesn't do well. A large pharma company, for example, had a loss this quarter because of some issue on write-off. All these play an impact on the price, right? Global news, very important. I mean, something happens in China, something gets hit here, something happens in the UK, it happens here. Tomorrow there's a COVID breakout in Europe, that will happen here. It will affect, right? We are now in some sense very intermixed. And of course, the last and most interesting one, at least from an Indian context, is political events. We are a vibrant, thriving democracy. So everybody is allowed to say whatever he wants. You can talk against the government. The Indian voter is reasonably unpredictable. That's been the experience of the last 20, 25 years. So if something happens, which the market is not very thrilled about, especially uncertainty, that could also affect markets, and that could affect valuations, and that could affect the way that curve happens, right? So it's not always a straight line. Many of these things sometimes create potholes, sometimes create a very smooth road. So it's like, imagine you're on a car journey where suddenly you will have Bombay-Pune expressway where you're doing 90 kilometers an hour, and at the end of the expressway, you could get a curve, which will, I don't know how many of you have driven. I drive there very frequently. So there's a curve at the end, and then you have to slow down. So that happens in equity too. And these are some of the reasons why those curves are there. Next slide. So what we want, of course, which you ask any investor, he'll say, hey, I want to buy low, sell high. That's the fundamental rule of equity, or not only equity. Buy low, sell high can be anything, right? I mean, any asset that you own, even if you buy a flat or you buy gold or you buy debt or anything, you would like to obviously be at the level where you want to be at the lowest level and sell. What unfortunately tends to happen, and this is emotion rather than rationale playing out. This is not only true of us in India, this is globally a fact. We typically tend to buy high and sell. Last 1.5 years will give you that example. But I must say, many investors in India, I think thanks to education, thanks to higher interest by people, I think they've done something very contrary. So last year actually was a very big revelation for me. You had a lot of people who came in the March, April month when the markets were really low. In fact, every time they bought the dip, they stayed invested, and actually September, October, when markets went up 30%, they thought, okay, that's it, we're done, and they got out. Unfortunately, that didn't happen. I mean, after that, you know what happened? September to September, again, the markets are up 50, 60%. Now, that's obviously the one that they missed. But most retail investors unfortunately tend to do this. And that's evidence really there. I mean, if you see the best time when the number of demat gets open, which is to tell you how many people are actually buying, selling in the stock market, the best times are obviously in boom periods. And last 1 year is a classic example of that, right? If you have to go back and look at it in 2019, maybe 1/10 the number of people were actually opening demat accounts. It used to be a pain. In fact, people are actually closing demat accounts. because they just got frustrated with the equity markets. And that's a symbol of, that's a sign of the second one, that people tend to such as like get frustrated, and because they feel that this whole thing is manipulated, they have their own rationale for it, and they just sell it. That's the worst thing to do, because you've effectively taken a loss, right? You're not allowed your investments to play out. You're not allowed equities that level of time. And so I think uh, what we've done is to try and come up with a much easier solution. That's what BAF actually does. Next slide, please. So I think typically what a BAF does is exactly on the right hand side. So when the market is cheap, say hypothetically the market was let's say cheap, and this you would treat BAF will suddenly become an equity. And that doesn't mean that it will get 100% into equity. It'll have about 70-80% money into equity. And markets are reasonable. These are how do you determine this is interesting, but yeah, when you markets, this is how a fund is typically a BAF is supposed to be. And obviously, when markets are expensive, it becomes what is called a conservative hybrid fund, which means that the equity allocations get much lower. So this is actually that happens. And how does this work? I mean, this works through a modeling basis. Essentially, what it does is obviously it takes away the subjectivity, which I told you in the previous slide. Equity investors have been it takes away the emotion. It puts into play a bit of a rules-based approach. People look at there's a reason why equity is high or low. I think in some sense, especially because it tends to be a little reverse compared to markets. So typically, most retail investors have their highest equity allocation when markets are at their peak, and vice versa. This fund does exactly the reverse. I mean, this fund will have a higher allocation to equity when markets are low, and obviously reduce that equity when markets are high. So I think in some sense, everybody asks me, is 58,000 a good level to index? Raghav, last couple of days, markets have fallen 2,000 points. It's a good time to come in. Frankly, I don't know. I mean, nobody does. It's not that I don't know it. Nobody does. Because the market, as I told you, is a collection of various people's investments, desires, needs, actions, right? So it's very difficult to say whether something is right at a particular point. So it takes away that whole fun of, or the whole pain of market taxation, of market timing. And lastly, I think because to promote equity savings, I think the government offers a much lower level of tax. This is for people obviously who earn and pay a lot of tax. Most of us do. Equity taxation, as you know, if you keep it for more than a year, the gains are taxed at 10%. And if, of course, if it's less held for less than a year, then it's taxed at 15%. So as compared to, let's say, normally what we pay 25, 30, 35%, it's almost half that rate. So obviously, this fund, in some sense, acts like that. So it behaves like an equity fund. Next slide. So this basically I've completed about 2/3 of what I wanted to talk about, which is essentially what the market has been doing. And I sort of ran through that because I'm sure you guys have a lot of questions. And of course, the fact is that what does a balanced advantage, what does the category do? Where does it behave when it behaves? What's the need of it? So if I come to Axis BAF, next slide, please. I think clearly it has obviously the three big functions. It's a dynamic allocation, which is that the equity keeps moving in a range from 0 to 100. Obviously, there are models built in and to take care of valuation, to take care of momentum, and where we make sure that the equity allocations are lower. And God forbid, if there is a market crash, it sort of helps you in managing the downside. And then, like I said, it is tax efficient because it's categorized as an equity fund. So obviously, any gains that you make out of this is taxed at much lower levels as compared to normally high rates of tax that we pay on some of our other investments. So what it does is it tries to navigate the volatility, because obviously the journey is from point A to point B. The road, as I showed you in the beginning, is not a straight road. It curves. It's not the Bombay-Pune Expressway, which is a straight line. You will have issues. You will have potholes. You will have work in progress. And I told you why those things happen. You could have central bank action, quarterly results, political issues, FIs coming, buying, selling. All that, in some sense, is what we will try. Makes equity investment a little volatile. This fund tries to navigate that. Right. Next slide. So what this does, Axis does two things. I think The balanced advantage category, that is an interesting category because every all of us have their own way of managing the equity exposure. So we look at two broad uh, variables when we look at how much equity we should have in the portfolio. And this is important for all of you. We look at market valuation, which is nothing but your price to earnings, your price to book. All those parameters are available readily and they keep getting updated because of quarterly results. We also look at something called the market trend, which is basically what's the mood like in the market, what's the buy sell ratio, what's the ratio of advances to declines, and that's also easily available in the market. And based on this, we have a 4x4 matrix, as you can see. So obviously, the best time when our equity will be at its highest will be as possibly when the market trend is favorable and obviously valuations are low. Right? This rarely happens. I mean, it has happened in the past, but very rarely. Most of the times we'll be in the bottom quarter. Actually, we'll be where we'll be between equity and equity exposure between the 30-70 range. And in that sense, Axis is a bit unique because the valuation part of it is called the counter-cyclical part, that everyone knows that you will have to invest when equity valuations are low. But what we also do is we also put something called momentum or pro-cyclical. That's called pro-cyclical, where we also take into account the trend and the valuation. Now, all this is put into a model. And obviously, that model is looked at by my team daily. And based on that, I think we keep adjusting our equity allocations. That's the. So of course, this is all very nice to talk and very good to hear. But is there any real proof that this is there? Has it really worked in life? Yes. The next slide will tell you that. A bit of our report card there. Yeah. Next slide, please. So if you see the next slide, a lot of data, unfortunately, here, but typically we have looked at two parts where there is a market correction, where markets have gone down, and then more importantly, when markets have gone up. Now, obviously, understand one thing, this is a balanced fund, so obviously it will never do as well as equity when markets go up, and that's a question which always people ask me that, hey, how, market rise, what will this fund underperform? Yes, it will, because we'll keep slowly reducing the level of equity based on the previous slide that we told you. But what it does is it really takes care of the downside. So some 3-4 occasions, the last one that we all remember was the big one in January to March of last year, the COVID crash. Markets actually fell 40% in that period, 37.9 to be precise. The fund actually fell only 14%. So just think about it. Your 100 rupees came down to almost 60 rupees, whereas your 100 rupees in BAP actually just came down to 86 rupees. There's a massive difference in what actually happened. Now, obviously, this is good, but what people say is, hey, did you do well on the upside? I think we did reasonably okay. We made some changes to our investment model, so we're doing slightly better now. But if you go back and see the previous slide, let's say, again, 16 was a really big period, if you remember, where the market really took off. That was the last big rally before we had here. That was, if you remember, the Nifty went up almost 58% in that period of time. The model went up by about 31%, which is a pretty good number, given that most of our investors are conservative, they're first-time investors. There are people like me who are lazy to do their own asset allocation, so they just give it to our equity fund management, our investment team, and they get it done. I'm very happy. I mean, if I made a 31% return, I'm absolutely fine. So as you can see, the model has done well. Obviously, in today's context, it is that's why the category is doing so well, because everyone's actually more worried about the first part, which is that everyone's saying, hey, markets have gone up so fast. It went up from, literally 30 to 60 in a matter of like hardly 15, 16 months. Everyone's expecting a correction and everyone's worried. When they're putting money, it's not an easy market to invest, right? So that's where this category's got a lot of money. And that's where I think when people are investing, they are obviously giving us a reasonable amount of money to manage to. Next. So quick thing, what we're doing right now, obviously, we are also concerned on valuation. We're concerned about the type of investor that we're getting in here. So obviously, if you can see, the fund is very large cap tilted. Why large cap? Because large caps have the ability to cushion a market fall better. Number two, they also have more sustainable earnings visibility. You can make out earnings for a period of time. Lastly, I think their ability to ramp up, especially when economy does well, is much better. So obviously, we are in that sense more large cap focused at this point of time. We're quite concentrated. Our top 10 holdings account for about 32%. If you look at the names, there's not a single name that you would not be knowing or not dealing with in your regular day-to-day life. At Axis, our life is all about being a bottom-up. We like to know the company that we invest in very well. And that's what we mean by bottom-up stock picking. We look at a company from various angles. We have a huge number of filters to make sure that the company fits into our universe. And then number two, it translates from the universe to our portfolio. That's a fairly long journey for any company to do. But once we are there, we feel that we own the stock pretty well. We are okay for short-term underperformance in our stocks. We understand that that is a part of the normal earning cycle. But what we're really looking at is a company constantly compounding over a reasonable period of time. So if you see the next slide, you see the names are pretty much the names that, yeah, next slide, please. You will see the names are pretty much the names that have done well. Right now, of course, we are more focused on the software space because obviously there is a huge amount of digitization opportunity available. Right now, most companies are only talking about the mega wins that they've had. Our belief is that the next round will happen even when small wins will keep happening. So this digitization or movement, India is in a far better position compared to a lot of the world. And in that sense, we have the ability to, in some sense, digitize the rest of the world, right? Or rather, improve their systems. And that's what's happening across. We think this whole unlock thing, which is happening, 100 crore doses done, life slowly coming back to normal. I mean, if you guys are going somewhere over this week, you will understand the rates you're paying are going to be criminally high compared to what you would have been paying 6 months back. People are consuming more. Lots of stuff happening on the real estate side. I think all newspapers, if you open the first 4 pages, are all about things. So essentially, I'm saying communication coming back, consumer durables coming back, and of course, petroleum is a big story, which is a couple of stocks there. So if you see, that's largely it. I think we've had a pretty concentrated portfolio of our top 10 essentially accounts where we are really large investors in the companies that we like. Right, we don't go and then buy 0.5% or 0.75%. We are there at reasonably good rates, right? Next slide, please. So this is just a quick slide on how we've done, and as we just tried to make it color coded for you. So the orange part is the one that is interesting because that's the orange plus the blue or the red is the one that actually is the hedged and unhedged. And the unhedged, we use what's called arbitrage to make sure that the fund maintain 65% minimum equity exposure. So at all points of time, irrespective of whether if you go back to say November 20, when we felt markets were reasonably priced, we had only 35% in unhedged equity. But the fund was categorized as an equity fund because it had 30% in arbitrage, which actually behaves in a more predictable way, something like our debt assets. And debt has been largely constant, as you can see on top. It's largely been in that 25 to 35% range. So that adds a little bit of stability overall to the portfolio, right? Next, please. So to just summarize, I think this is fund in some sense like the hero on diet, fill it, shut it, forget it. I think my belief in life and my experience is that I think time in the market is much more important than timing the market. Having said that, the journey is twisty. It's not something which is straightforward. You will have days where your portfolio will not do as well as some of your other investments, especially fixed deposits. This is a great fund for people who want to caution their downside, as I showed you in the previous slide. When markets tend to fall, they tend to do very well. It's obviously meant for more a conservative investor. And of course, I think, like I said, you must have a decent investment horizon over here to really benefit from the volatility that this fund aims to capture and benefit on your account. So yes, the next few slides are all about the statutory slides about what this fund is, what's the index level, who's the fund manager. I think you have all the options available, so minimum 5,000 rupees, etc., etc. So yes, that largely covers my PPT. Maybe Siddharth, you can just run them through the statutory slides in terms of performance. As I said, it's done reasonably well. We have the norm in the industry is that yes, fund managers who manage a various number of schemes, you'll have to show a consolidated label of all the funds that they manage. That's good because it gives an investor an idea as to all the things that he's managing. So these slides are largely to do with that. So thank you very much, audience. Thank you very, very much for taking again time off on a Saturday, especially on a Diwali weekend. I must take this opportunity to wish you and your families a very, very happy and prosperous Diwali and Happy New Year. We are in for some interesting time. I think very clearly Equity markets are always a little ahead of the times. So yes, I think the equity market is clearly saying that the Indian economy is in a very, very different place. That's what our global investors also seem to be saying. Uh, Maybe you and I don't recognize it because we are focused unfortunately on the short term. We look at life as a traffic jam. Uh, you know, nothing fundamentally changes in our life when markets go from 30 to 60. We live in the same house. We practically eat the same food. Yeah, we do a little more consumption because we feel a little richer. And that sometimes, that tends to give you a little bit of a short term perspective. But if you look at life over a 5, 10 year perspective, which is what equity markets do, you will see that a lot has changed. And I guess the world is saying that a lot more will change for the good for India. So in that sense, yes, Mera Bharat Mahan. Finally, our decade has come, our century has come. We hopefully will see some huge progress. And that we have seen in the past whenever various GDP levels get achieved, a lot of things changes and they change at a level that you and I unfortunately don't get to see because it is in some sense slow change. So I'm sure the India of the $5 trillion GDP India will be a very, very different country from what it is today, which is that $2.5 trillion range. Right? So let's in that space, the only way that you and I can benefit is by being owners of companies which will do well. One way to do that is to invest in mutual funds. But as I told you, the ownership of companies comes with its own set of stuff that we don't know about. I talked about their earnings, the political things. There's so many other issues which are there. There's a lot of news flow. The news channels will obviously tell you what's happening today, what happened yesterday. They will not tell you what happened 5 years back. And more importantly, they're there to report. So they will not be able to figure out what's going to happen 5 years later. That's not their job. So our job as investors is to cut off the noise and try and focus on our asset allocation and do it ourselves if we can. That's great. But if you can't, use balanced advantage funds. And yes, within that space, if you can use the Axis Balanced Advantage Fund, that will be great for all of us. Yeah. Thank you again. And yeah, sure. If there are any questions, we can do some questions.
Thank you, sir. Uh, we have more than 300 questions that have actually come in, so we'll not be able to take all of them. So what I'll do is I'll
Can you
take
take the
some.
presentation off, please? I think, yeah. Sit.
Yeah. So
Yeah.
I'll take some few of the questions and then we'll try and club in wherever it's possible. So the first question is from Mahima Agarwal. What is your advice for beginners and new investors?
That's a lovely question. I think, especially coming in the Diwali week. Diwali is a period where we all try to do something new, start something new. Our elders used to always tell us that it's very good to start something in Diwali. So the first thing my advice to you is, madam, please save as much as you can. In fact, if you can save 30% of the net that you take home after taxes and statutory stuff, that would be a great thing. Number two is obviously make sure that you're well insured. I think that's a critical part that we all tend to forget, especially health insurance and life insurance. I think this last 18 months have shown us how fragile things can be. It's always good to be, in some sense, protected against that. Number three, yes, I think if you have, depending on your risk level, how much of risk appetite you want to take. If you are somebody who has no problem with 100 rupees going to 60 bucks, yes, then please be invested in equity. If you're someone who's a little scared like me, who's worried about 100 rupees going to even 80 rupees, balanced advantage fund is a good place to start earning, start putting money as a first step. Like in everything, test it, get used to it. You're basically investing for your mental satisfaction, for your mental peace. So the day you get more comfortable, then slowly go up. I find a lot of first-time investors, especially in this rush to catch up, start putting money at the most risky part of the market. So I can talk from my personal experience. My first investments were in a technology fund 22, 23 years back. And, though it did very well for a period of time, but when it fell, because it's a very narrow sector, some things happened, Y2K happened, a lot of stuff happened around it. Valuations got stretched, a lot of other things. It really fell like a stone. So then it was a fairly roller coaster ride for me. The good thing I did was I had a friend who told me just stay invested. The companies that you are pretty good. So I did. So over a period of time, over the last 15, 20 years, it's given me a good return. But that 1 year was scary. So my advice is first save, second insure. Number three, make sure that you invest in the asset allocation that you're comfortable with. If you're not clear about it, just put money into a balanced advantage fund. Let the asset manager, let Access manage that. Whether it should be 20 or 80 or 50, let us do that. Yeah. Next.
Okay, I've clubbed few questions. So, are balance advantage funds suitable for SWP and retirement planning? The second part would be, will it be helpful with regular monthly income? And can a 65-year-old retired person start SIP and balance advantage fund?
Oh, let me start with the first question. I think it's an interesting fund to have from an SWP perspective. What is SWP? Systematic withdrawal plan, for people who are not aware. You can give us advanced instructions of how much money you need every month, and like how it's the exact reverse of SIP. So SIP, we will take money from you at a prescribed amount of money on a prescribed date every month. SWP is just the reverse. We will put in a prescribed amount that you want on that date into your account, right? There are various ways to do it. You can do it in any scheme, a debt scheme, a liquid scheme, an equity scheme, or even like PAF scheme, like Shoaib mentioned. I think the good thing is that there is you can think of SWP here. It's important, but I would only suggest one thing, that let let your corpus build up for a certain level of time, and then do an SWP. Don't start immediately, because then you may be eating from your own principal. Number two, just get a sense of how much your expenses are. If your expenses are much more than the SWP amount, you will actually be again into your principal. So you need to adjust that many. The last question, I think, Shoaib, was on BAF being a good place for SIP. SIP in BAF is always a great option, especially for a retired person. It's an absolutely fantastic thing. See, the other thing, please understand, mutual funds are, unlike other instruments, are very liquid. So many people tell me I have retirement money parked here, but just remember, if you need it, you can access it within 72 hours. Like 3 working days, money normally hits your account straight away. Right? So that's the big part. That especially for retired people, money is easily accessible. A lot of people I know who are retired have a lot of money, but it's unfortunately locked up in physical assets and stuff. So it's very difficult for them to sort of take it out, and especially when they needed it. Like let's say last year was unfortunately a bad time when a lot of them needed that money. They didn't get the right price for it, because in some sense they were distressed. So yes, please use balance swap for SWP. Please use it for your for meeting your retirement goals. Please use it as a source scheme for this thing, because also from a taxation perspective, as I said, any withdrawal from a BAF fund attracts much lower tax compared to, let's say, withdrawing from any other scheme or withdrawing from a bank. The taxation impact is much lesser. So if you keep that's a good idea for you to do.
So, Mr. Dwivedi is asking, are these funds suitable for investors retiring within 2 to 3 years? And one more gentleman has asked that, are these funds good if I have an investment horizon of 3 to 4 years and want to invest lump sum now? And after 3 4 years, he'll be perhaps taking it
I
out.
think that's a fair time to keep some money, though ideally I would like him to keep it for 5 years. So yes, I think bank is a great place to put money if you have a minimum 3 year horizon. Ideally, it should be for a longer period of time, but yeah, compared to say putting money to a plain vanilla equity fund right now, BAF at least will hopefully give you a slightly smoother investment experience. As far as Mr. Dwivedi is concerned, yes, I think the one challenge, and which all of us have and will have, it's a good challenge, is that unlike our previous generations, our lifespans are definitely going to get much longer. That's a combination of our current health, current medical facilities which are available, and obviously the diet that we eat and all the things that we do. So the challenge is that we may run out of money. So before we actually move on, right? We may actually have, because most of us are used to putting money of retirement money into fixed income instruments. Nothing wrong with that, but you do need a little bit of equity to beat inflation, which is been quite high and is expected to be reasonably high also, right? So yes, BAF is a great place for you to save for your retirement. In fact, as my view is, as you get closer to retirement, you should slowly start trimming down your equity holdings, especially in today's market, and try moving some of that money, especially which you don't need in the next 4 or 5 years, to put that into BAF, so that every 4 or 5 years you have a certain amount of money that you can touch, and obviously BAV, because of its unique asset construct, that we can go from 0 to 100 in equity. Axis BAV can give you a better experience. So in that sense, yes, over a 5 year period, you should have a better retirement pool for you to take for the next 5 years. Yes.
Okay. Deepak Kulkarni actually asked two questions. The first question is, should one do SIP or lump sum in balanced advantage fund?
I will stop
So,
there. But Shoaib, I want you to ask me one question at a time
okay.
because you are very intelligent. I'm going to miss out on some answers. So just do one at a time, if you don't mind.
Okay. So the first question would be, should one do SIP or lump sum in balanced advantage fund?
And do both actually. There's nothing, there's no thumb rule to it. I think the key thing is that a lot of people ask me today that in today's valuation, what do you recommend? I think for people who are not really on top of their regular money management and are unable to adjust their asset allocation in a disciplined way, a lump sum in BAF is fantastic. But as a discipline, SIP is nothing but a discipline, right? You're disciplining yourself to invest a certain amount of money every month. So most of us, at least when I started life, what got left over at the end of the month was my savings. I think today's world is very different, and compliments to all of you. Today you start with savings, and then what is left over is in some sense the consumption. So in that space, SIP is a great idea. And there's enough evidence to prove that if you keep money for a long period of time, you get reasonably good experience. You're able to, SIP in some sense takes away the volatility. So SIP is also done to smoothen out the volatility in equities. So in some sense, BAF is already doing that. So I would suggest, at least personally, I'm not a big fan of SIPs in BAF. But yeah, again, depends on your age, your risk-taking appetite. Like somebody asked us just a couple of questions before, if I was a senior guy and wanting to start an SIP for money I may need 5, 10 years later, I would rather do that. But let's say if I was starting my life, if I was a young person and have some risk-taking ability, I would rather do an SIP in an equity. But these are best done, these conversations. Yes, I love to. There's no general rule. I think each individual is unique. Sure. So one needs to actually go and talk to what I call a mutual fund distributor or a registered advisor to get a sense and try and get some more personal cash flow put into it to give you a much better out. What I'm giving you is just uh, broad guidelines, broad thumb rules around. But ideally, these conversations should be at a more individual level because every person's needs, situation, risk-taking appetite is very, very different, right? So there's no one rule, one size fits all kind of thing. So my advice to you also, sir, is to just go and talk to somebody you know and have a conversation with him or her about that this is your cash flow, this is what you need, and accordingly take it.
Okay, the second question is, between BAF and equity large cap, which one would be a better choice?
Again, very personal decision. Risk taking. Large cap in that sense is a slightly lower volatile, lesser volatile product. As I said, large caps are companies which are mega companies. Right? We're really talking of the Nifty 50 or the Nifty 100. So these are some of the best, largest companies in their particular sectors, well managed. They have a long track record. They have the ability to be able to take short-term issues very, very comfortably. In some sense, they are how do I put it? They are giants, right? So I would again, as I said, age, risk appetite, tolerance to loss are very, very critical decisions in this. And uh, hence, again, from my personal perspective, I put money into large cap SIPs only. I don't have a PAF SIP story, but I'm unique, as I said. So again, those conversations should be done individually with someone who knows the person's finances better and his risk taking appetite.
So, next question is by Mr. Hazra. He wants to understand the difference between index fund and exchange traded funds.
Oh, okay. All right, that's a nice question. Index funds they're pretty similar actually from a construct of what you buy. Like if you go and buy a Nifty ETF or you buy a Nifty index, stocks are going to be the same. Of course, for the ETF side, you need a demat account. You need to go through a broker. Of course, the advantage of an ETF is that you're getting live prices. So in some sense, you're buying it live. So you actually get the price at the time when you buy, in and around. Whereas, as you know, in an index fund is offered, you don't need to have a demat account. It's like any other normal mutual fund scheme that we offer. In fact, we are launching Access Nifty index fund now in the next 10 days. It's just a vehicle. But there you get the day end price. So many people tell us from a convenience perspective, people who don't have demat accounts, people who don't do or don't use brokers or come directly through other partners. An index fund is an appropriate vehicle. Whereas people who want midday prices, who are a little more aware of market, who take intraday calls, as you know, like yesterday you had markets fairly wide swinging. If people want to take advantage of that, instead of doing it in a stock, which obviously is a little more risky, they want to do it through an index, then an ETF makes sense. So all of us have the same thing. I mean, we have an ETF, we have a 50 index. Both are available. Just depends on the type of investor and what you want to do with your investment. Yeah.
So many people are asking this question as to why Axis Balanced Advantage Fund and how is it different from its competitors?
Oh, okay. The good thing in the balanced advantage category is very, very unique because every fund house or every scheme has a certain different way of managing the level of equity allocations, right? So many fund houses use price to earnings. Some fund houses use price to book. Some fund houses use momentum, which is direction of the market. Some fund houses use historical earnings. So I think the difference. So in some sense, one needs to be careful because when you use different parameters, obviously the results are going to be very different. So sometimes just looking at the 1 year return or the 6 month return or the 3 year return may not give the right perspective. So what we have done in Access is to, as I said in the presentation, try to use both, right? We've tried to use a valuation parameter and we also tried to use a direction parameter. So we have a 4x4 matrix. We try and fit the data into it. And then based on both the combination of both the results that we get, we determine our equity level. For me, but primary source or a primary ability to do is to just ensure that in bad times, how is my balanced advantage perform? Right? In good times, I know it will never perform as well as my equity because obviously the amount of equity or the percentage of equity is much lower in a balanced advantage fund as compared to a regular equity fund. The trick or the key determinant is how is it done on the way down. And that's something that investors should be very, very clear of. I mean, more than the model and all the other stuff, that's nice to have from an academic interest perspective. But the question that I would ask as an investor is, hey, how is the fund done? Give me 2, 3 instances of when the market fell, and how is that fund done vis-a-vis the rest of the world? And uh, that in some sense is the real proof of how good or bad a balanced advantage.
There are many questions, so I'll just club all of them. Primarily, what people are trying to understand is people want to know what are the different type of hybrid funds and who should invest in each one of them.
So effectively, there are 4 hybrid funds, 4 types. As you know, there is a conservative hybrid fund, which used to be in my time earlier when I started life, used to be called the multi-income plan. MIPs are no more in existence. They have anywhere between 5 to 30% of equity. Then you have what is called the equity savings category, which normally is between 20 to maybe 50%. Then you have what is called the aggressive hybrid, which is normally 65 to 80%. And then, of course, you have the balanced advantage category, which can go across. In some sense, it can go all the way from 0 to 100. So you have, if I were to draw a graph, balanced advantage will be right down, and these would be on top. Now, obviously, as the name indicates, aggressive hybrid is for people who have a better view of equity. They're able to take slightly higher losses, but at the same time, they want some cushion. So somebody who's got a higher risk-taking appetite, who's got a slightly longer investment horizon, but at the same time, is not very, very 100% confident to put his money into a 100% equity fund should go there. Somebody who's moderate, who needs money in say 2, 3, 4 years, can look at equity savings. It's a great place to be in a 40, 60 product. The market falls, this category has done very well. In some sense, it is the 50-50 of the industry. Like 40-50% is in equity, 40-50% is in debt. And many people have this view that hey, a 50-50 allocation is very easy for me to mentally manage. And yeah, we take that 10-15% higher because of arbitrage. But largely the open equity is between a 30 to 40, 30 to 45% rate. So obviously that's a good place. Also, those funds are also doing well. We have a fund in that category which is also done quite well. And of course, you have the conservative hybrid, which is a good place to put money if you are. Those get treated as debt taxation, by the way, because the equity allocation will never go to 65%. Right? So they will be debt taxation. But yeah, those are funds slightly much more conservative investors, as the name done. They want a majority of debt, but they want a little bit of equity to sort of try and give a slightly better return. So it's just as the name indicates, and I think that's where the regulator's done a fabulous job. It's very clear now. I mean, if you're an aggressive investor, longer time horizon, go to aggressive hybrid. If you're confused, like most people are, and they say that we don't know what to do in equity, should we be in 50-50, should we be in 80-20, then I think the balanced advantage category is the best place to be. And in some sense, that is what has been happening. If you see the last 3-4 months, uh, huge flows going there because frankly, people are not very, very clear about the direction of the markets. They are very worried about loss from here. So they said it's better than to entrust it to a fund manager, especially to people who have the ability to protect in the downside. Right? So new flows are going there in some senses.
Okay, sir.
So I think we should do one more question because I can keep talking. It's 11:29, and I think people have other things to do, and I don't want to take them away from their Diwali week. So my request is just let's take one question, then we done.
Okay, sir. We'll do one more. Uh, how asset allocation is done in this fund, and how is it liable to change according to market situation? So,
I
Mr.
thought I
Bora
mentioned
wants
that
to
the allocation is
understand the
done.
difference.
I think the key thing is, as I said, there are a set of variables. I think you have to have a set of, like I said, you have the momentum based variables, the direction based. Then, of course, you have the valuation based variables, which is price to earnings, price to book, a lot of other variables. And you mix these two variables up, then you get a result. And that's the whole thing that's there in the model. And in some sense, the model throws it out. So, in some sense, there is no human intervention there, largely. It is mostly model based. See, but what people must understand is that fund managers also are human. So what this does is that it takes away a little bit of the emotional aspect of it, takes away the day, or takes away the feeling that you are in today. I mean, today everyone's feeling happy because index is at 58,000, but 2 years back people are very, very sad. Ideally, 2 years back we should have had much more allocation to equities as compared to today. Ideally, on a valuation perspective, right? What this thing takes away is because of those variables that it puts in, it takes away the emotion out of it and then allows you a certain amount of equity to do. So that's the way that broadly happens. So I'm sure there are a lot of questions. My request is that maybe if you could get if the team could get a list, and then we could reach out to the investors or the people or the attendees of this call uh, and just sort of answer them individually. That would be good. But again, my sincere thanks to all of you. Uh, I was actually a little worried because I was very, very unsure how many people will turn up. But this is something that we do at Axis Mutual Fund very frequently. It's a monthly program for us. We try and look at various topics. The reason we picked up Axis Balanced Advantage Fund was one, there have been some changes, as I said, to the way we have managed the model. And it's useful for me to tell you that. Number two, I think there's also to give you a brief on what in some sense is an ideal solution in today's world. That yeah, just put money into hybrid funds. It's a good place. But there is a place for all funds in everybody's pocket. I think there are a set of investors who have, including me, who have a very, very positive view on the long-term prospects of India's future. I don't know what will happen in the next quarter, next 6 months, next 1 year. So I will have a much higher allocation to equities. There are a set of people who want to be in equities but are very worried about the downside. Naturally, so especially seeing what happened last year. For them, obviously, this category is an absolutely wonderful place where, in some sense, it takes care of that stress of downside as best as we can. Yeah, I think, thank you very much again. Have a very, very happy Diwali and a very happy New Year. God bless you. Stay safe. Thanks a lot.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.